Hi, this is Shiney here from Cochin, and a very warm welcome to all of you. I have Mr. Anil on a very interesting hot seat. So we're going to have a lot of questions from us in the distribution. So I think, as a wise man once said, may you live in very interesting times. And I think if I look at the last 18 months, you can't get more interesting than this. We have seen a whole lot of crisis on the social, on the economic, on the health front. And what I really find interesting is how do you manage, in these times?
As you rightly said, I don't have a better word than interesting. Maybe there is another word out there. We moved in from last year, March, from mayhem or, end of the world to an absolute different end, or different, completely, not only a U-turn, but a V shape as far as markets are concerned. Across the world, again, it's not just an Indian phenomenon. And rightly so, it's interesting, but at the same time, one of the more challenging times that I've faced over the last probably 9 to 9.5 years on the buy side, at least on the fund management side. How will the picture really emerge? 12, 18 months from now, 3 to 5 years from now, post-COVID. What's the new norm from a post-COVID perspective in various aspects? Working from home is one aspect. How will consumption patterns change? How will delivery patterns change? Will travel come back? Will leisure come back? Will business travel come back? A million things. Will supply side, which is today clearly, start globally. I mean, it's starting with it starts and stops depending on which part of the world. Suddenly the COVID's moved a little higher, and the lockdowns, etc. So keeping all these things in mind, yes, it's been extremely interesting and challenging. And one is trying to keep rationality cap constantly on and keep evaluating that, what would it be to, kind of see that, how will the real world or the rational world look like post this. I think that's the key thing, to keep your thought process and keep your style of investing constant the way it's been over the last so many years. Don't let short-term, data points really affect your style of investing.
Yeah.
And keep to your ethos, which is, good quality management, businesses that you understand, go deeper into businesses. Again, these are great times to, to really see how businesses really are reacting, and so I think from that perspective, it's a great learning. Yep.
When I see the kind of rush that we saw last year, if I see the way the markets move in the last financial year, say the 1st of April till today, it brings with it a lot of expectations from people who have climbed on board equity bandwagon for the first time. How do you see the landscape ahead from here on? Because that's something that I think you all have to live with, a huge amount of expectations given the performance in this very recent period.
No, so basically you're asking what's the view on the markets, in short.
Yes.
Right. No, so I think clearly, as I said, before in the first question, it's extremely challenging right now to, gauge in terms of, when will the new normal really come back? We keep talking about the current phase of the pandemic, and there's already talk about a third phase, which is imminent, and no one really knows. We are also aware of the fact that, India, as we speak, the vaccination as a percentage of population is going to take a reasonable amount of 6 to 9 months to really catch up with, the rest of the world, which has seen significant drop in the COVID cases only after they reached, 60 to 65% of the population being covered, and from a vaccination perspective. So I think we will take time for the, as India from a pandemic perspective. And we've already seen signs that, in just about 27 to 30 days, things have significantly improved on the pandemic front as well. But I think from a market perspective, as we all know, and this various cycles of the markets, be it the 99-2000 cycle, be it the 2003-4 cycle, or be it the recent cycles, markets, will always extrapolate the good, and for that matter, will always extrapolate the worst, as and when it really gets the worst. We are definitely no doubt, we are in the current phase wherein we are basically believing that everything that's good right now will continue, and that doesn't necessarily happen. So the real world has, told us, and the markets has told us this. many, many times over, not just the Indian markets, across the world. So I'm a little bit more sanguine to a bit more realistic in terms, and I would like to give this message very loud and clear to the investor community that what we've seen in the last 1 year is genuinely a one-off. You don't get these kind of years for years together. You will not get these kind of years. So if people are expecting a similar kind of returns, they really need to rethink back again as to what are you investing for. It's been a Goldilocks from a last year's perspective, and to repeat that is almost, it's almost going to be improbable, I would think. But if we look from the next 3 to 5 year perspective, things definitely can look and will look much better. But very difficult to gauge the next 12 months, primarily because of various factors. And, it's going to be a little long answer, but if you're fine, I can, we can go through that. It's not going to be an easy answer, just given the fact that the uncertainties that are surrounding need to be well spelled out for the answer to really be making sense.
And then what I'd love to hear from you is, what was the changes that you made? Because when we had funds becoming multi-cap, then the option to go flexi-cap, all of that. Would you like to share with us, how did you deal with the change, with this kind of shift?
Just no change. We just changed the name.
Well positioned to be in the flexi-cap strategy.
Absolutely. There's no change. So let me again rephrase. We just changed the name from Aditya Birla Sun Life Equity Fund to Aditya Birla Sun Life Flexi Cap Fund. There's no change in strategy. Since 9 years that I've been managing the fund, it's been my constant endeavor to keep mid cap and small caps between 25 to 35% at all times. And, that even when it was multi-cap, whatever you would like to call that, even when there was always a flexibility for the fund manager to move, from 0 to 100%, it's academically possible, but practically not. But nevertheless, even when that flexibility was there. And, I always believe that it's a very clear, in my mind, there was a clear pyramid. And I mentioned this to investors before it ends. There's a very clearly pyramid structure in my mind, which was there. That if an investor is coming into equities for the first time, advisors like yourself would really, get them into large cap because they're more, obviously the volatility is low. They are much more well-researched stocks. And once he tastes success and, he wants to slightly increase the risk factor, though, in terms of, wanting a little bit more alpha and happy to take a little bit more extra risk, I thought it was then the time for him to, to get the investor into a multi-cap category, because you then have slightly more mid-cap and small-cap exposure compared to the large-cap funds. And if he still wanted, that's where I always positioned the Aditya Birla Sun Life Equity Fund then, that, you want slightly more alpha and you're willing to take that slight more risk, then you come here because that's 25 to 35% bracket. Mm-hmm. If you really need more, then, there is a mid-cap fund by itself, okay, right, which was 50% plus. Now, of course, the pyramids got even more structures. So irrespective of, the SEBI change or the move that really happened, we were there, and absolutely made no changes. So, I continue to endeavor to keep it between 25 to 35%, and the experience in the last 9 years as far as managing this fund and, is that keeping it at that sweet spot, I believe it's seamless because it's giving a good experience to the investor. Again, if you see the performance of the FlexiCap fund, which was erstwhile BSL equity, it's really done consistently well over the last 9 to 10 years, year after year, and it reduces the volatility significantly. So with lower volatility, if I'm going to give a seamless, positive experience to the investor, I think it's job well done. So, we really didn't need to reinvent ourselves. We have the hindsight for the last 9 years performance to say that we believe we found the sweet spot. And that 25 to 35% is just perfectly good enough to give a measured, low risk and seamless, good experience to investors at any point of time.
So one question that comes to mind is that in a very, let's say, flexible strategy that you run, what is the kind of timeframes the investors should come in with?
Good question. So, for instance, I would like the investor to give me the same time frame that I give a management. You cannot judge a management of any company based on just one cycle. I mean, you cannot base if there's a positive tail, if there's a positive wind blowing and the management does well, okay, because of the positive wind blowing for that particular sector, would you classify that management automatically as a AAA management? No. There are various things which go. So it's a cycle that you want to see. How does the management do in good times? Do they go ahead and, mess up the capital allocation? And how do they really do in bad times? In terms of, how are they really tightening the belts? How are they keeping on course? And, as a fund manager, if I'm giving the similar timelines, okay, to judge a management, and, if I'm investing, I would remain so as an investor for that company for at least the 3 to 5 years. Okay. Then, that's the timeline that I would like the investor to give me to judge any fund manager, forget myself.
Can you give us some more details on how you run the FlexiCap fund? Like, for example, choice of industries, what's the kind of top holdings, some more on the portfolio per se, that you're running it as you stand today?
Sure. So I'm a far much more top-down guy. Not that I don't do bottoms-up. I think in India, it has to be a combination of the two, but I spend significant more amount of time, reading more from a top-down perspective, which is, how's the globe doing? What are the issues in the globe? How are the interest rates in the globe likely to move? How is the FX likely to move? Then come down to India macro, and then actually come down to emerging markets. Then find, how is India looking within these emerging markets? Then go to the Indian macros. Okay. Then move within the macro and within, whatever it is. Then you decide on the sector. And once you've decided on the sector, that, then of course you just go into the companies and, whichever the companies are there. If you're extremely bullish, you will have an exposure which is, spread across 3 or 4 companies within the same sector and decent weight. Of course, you'll do a due diligence as far as, each of the companies is concerned. So the way I run the portfolio is always think more from a top-down perspective. And yes, to make sure that, we have more than 4,500 companies listed in India. So you don't want to miss anything from the bottoms up side as well. I continuously keep running a lot of, query modules in terms of, data analysis, etc., on a weekly, bi-weekly, monthly basis to make sure that, something kind of crops up or meets the, your filters that you put in place. And
how do you see equity from a broader space, not just as?
So I keep saying, as an asset class, equity is here to stay. It's one of the, it has to be one of the larger allocations towards equities. But again, it's the time frame that you are looking at, that's the more crucial part. So, if you want to put bulk of your money to work today from the next 3 to 6 or 1 year, then, the answer could be very different, saying, I really don't know, because, we've front-ended a lot of the good news already in the markets.
Yeah.
And, at the very least, I think over the next 2 years, and I don't know when, but the market really needs to have a reasonable period of time correction. It could, that's the bare minimum the market should do, which is, either it has a time correction starting now, or, we still move up further higher up and then eventually, correct a bit and then have some time corrections. But I have no true doubts in my mind that there is some bit of a time correction that's coming. And that doesn't mean that the investor should run away. That's exactly the point I'm just trying to make. That do not look at a 1 year and a one cycle, as a cycle. You need to be looking at investing from a longer term perspective. And if you front loaded the returns, doesn't mean that the same returns are going to be replicated in year 2, year 3, year 4. But yes, if you look at it on a journey of the next 3 to 5 years, the returns will look much, much better than possibly your debt returns and possibly any other asset class.
Something about the portfolio turnover of the fund for the last 1 year?
So as I said, I have the lowest churn. I'm definitely in the lowest quartile as far as the churn of the portfolio is concerned.
And I think Anil has summed up in a way that to win a war, he is ready to lose battles intermittently.
Yeah.
However, if we look at 1 year, 3 year, 5 year, 10 year, 15 year performance, I think this fund has always remained in top quartile. So that speaks volumes about the level of consistency we have maintained. And Shiney, you also raised a very pertinent point here, that most of the times it's easier to question a fund manager right? And most of the performance related issues have to be questioned at the investor level itself. While we entered the fund, we entered with a goal which was to mature in 20 years, and now we are evaluating the funds after 6 months. So absolutely right. I think it's a combined effort of the investment manager, advisor, and the investor at large. And then there is a specific question that recently RBI has sounded a warning on Indian equity markets. Right? On Indian equity markets, that Indian equity markets have gone into a bubble zone, right? In spite of that warning, the market continues to grow, right? It has ignored those warnings. Where do you think that does the investor needs to have a follow-up action on this? What do you suggest?
So, I think I partly already answered this question that, we've clearly been in a Goldilocks, classic, beautiful scenario, which happens once in decades and once in centuries. It's been a great year. I would just keep advising the investors, to be aware of, what is it, and again, going back to the same thing, Tarang, is be aware of your timelines. Okay. Just because, my neighbor has invested, I don't really need to invest directly. Each one needs to know the requirements of the funds at various stages. Equity as an asset class is likely to remain from a long-term perspective. Shorter term, very, very difficult to, point out when the markets will top and where the markets will top, because liquidity is something that it's like, water seeping, from your, it's just like water seeping from a terrace, and if you just got a house below the terrace, the water will seep from it. Liquidity it's just guzzling everywhere. And yes, I think there are pockets where valuations have definitely moved ahead of time, no doubt in that. And, is there a likelihood of a correction? Very much so. I have again told people the same thing, in today's call itself, that, I think there's minimum that the market needs to do sooner rather than later is at least have a bit of a time correction wherein, the markets don't do much and, we move sideways so that earnings catch up. I think these are genuine things that RBI has talked about in pockets. I won't say this is true for the entire market as a whole. But yes, it's time that investors, particularly those who are directly rushing into the markets, why not? Even the ones which are coming through the mutual funds, do need to just, take a pause, go back to the drawing board and just understand that, they are not putting, a lot of money at work. So if, they should be able to, kind of understand the risks that they are taking.
So I think what I can get is look for a trustworthy fund manager.
Yes.
Study well before you choose a fund manager and stay with the fund manager. Trust your advisor to take you to a trustworthy and a fund manager with a great vintage and experience. We have Anil here. And also from the investor's perspective, the investors must also do not link their long-term goals with the short-term volatilities, right? End of the day, their responsibilities and their goals remain there despite the market volatilities. So I think this is a continued change. This is a circle between an investment manager, an advisor, and the investor. Thank you, Shiney. Thank you so much. And thank you, Anil, for your time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.